Hi. Let's learn about cash dividends. A cash dividend is when a company distributes money to its shareholders, usually from its current earnings or accumulated profits. It's different from a stock dividend or other forms of value, because it's a direct payment in cash. When a company pays a cash dividend, most brokers give shareholders a choice to either take the money or reinvest it in more shares. Companies use cash dividends to give capital back to their shareholders through regular, periodic payments. These are often made quarterly, but can also be monthly, annually, or semi-annually. Some firms also give special cash dividends after certain non-recurring events. Each company sets its own dividend policy and will occasionally adjust it based on their assessment of their financial situation. The board of directors of a company announces a cash dividend on a declaration date, which specifies the amount to be paid per common share. After that, the record date is set, on which the company determines who the shareholders on record are, and who is eligible to receive the payment. Then there's an ex-dividend date, which is usually 2 business days before the record date, and is the cutoff for new shareholders to be entitled to the cash dividend. Companies that pay dividends usually have stable cash flows and are beyond the growth stage. This is why growth companies often do not pay dividends, because they need their funds for expanding their operations. Some dividend-paying companies even set payout targets based on their annual profits, and may adjust their dividend policy based on their financial performance. When a company declares a dividend, it debits its retained earnings and credits a liability account called dividend payable. On the date of payment, the company reverses the dividend payable with a debit entry and credits its cash account for the respective cash outflow. Cash dividends do not affect a company's income statement, but they do reduce a company's shareholders' equity and cash balance by the same amount. Companies must report cash dividends as payments in the financing activity section of their cash flow statement. For example, Nike announced a $0.305 per share quarterly cash dividend payable in April 2022. This is a common practice for mature companies with stable cash flow. For fiscal year 2021, Nike saw significant year-over-year increases in both revenues and earnings per share. This example illustrates how a well-established company can consistently pay cash dividends to its shareholders. Here are 5 key takeaways. 1. A cash dividend is a payment made by a company to its stockholders in the form of periodic distributions of cash, as opposed to in stock or any other form. 2. Cash dividends are often paid on a regular basis, such as monthly or quarterly, but are sometimes one-time only payouts, such as after a settlement. 3. Most brokers offer a choice to accept or reinvest cash dividends. 4. Dividend-paying companies are typically established, with stable cash flow, and beyond the growth stage. 5. Dividend reinvestment plans, DRIPs, are increasingly common among companies and brokers. Hope this would help. Thanks for watching.